$60 million of investor money, poof, vanished. Property deals that never closed. Disputes to be settled in rabbinical court, and crowdfunding on the brink. It's all happening in the saga of Nightingale Properties, the biggest real estate scandal of the year so far. Let's break it down. Touted as a way to democratize access to big real estate deals for small investors, crowdfunding, which emerged in 2013, allows sponsors to raise capitals in small chunks as little as 25 grand for projects. The smaller check sizes allow more modest investors a crack at higher reward trophy deals, or so the story goes. Last summer, Nightingale, a New York firm run by Ellie Schwartz, went into contract to buy the million-square-foot complex called Atlanta Financial Center for $182 million, as well as another office building in Miami Beach. Now, to help fund the deals, Nightingale raised a record $62 million from over 700 investors through a crowdfunding platform, Crowdstreet. Now, Schwartz was no noob. His firm had amassed a 20 million square foot portfolio across the country, including major Manhattan properties such as 111 Wall Street, and had pulled off a legendary flip of the Coca-Cola building for $937 million. $10 billion enterprise sponsor Brink's trophy asset with huge potential in hot market, screamed the email from Crowdstreet to investors. But very soon after the funds were raised, investors sounded the alarm. Nightingale, they said, was not kosher about its track record, failing to disclose that it had previously lost a property to a lender and had defaulted on millions in loans on another property. Nightingale dismissed these two incidents as minor, and Crowdstreet at the time said that they believed those facts shouldn't really prevent developers from listing on the platform. The deal for those properties was supposed to close by last October. It didn't. Then February. It didn't. Nightingale then went mum. It stopped providing updates to investors, many of whom wanted out. In the spring, Crowdstreet finally decided that, hey, Houston, we might have a problem, and it launched an investigation. In June, investors tapped an independent fiduciary to figure out what the hell was going on. Last month, she had some answers for them, but not the ones they wanted to hear. The bottom line is that the money that was raised by both entities has been misappropriated, she said. Tens of millions of dollars vanished for now. Crowdstreet effectively threw its hands up at the revelation. We have never experienced anything like this, CEO Torstein told The Real Deal. If someone doesn't follow that, i.e. the rules, and misappropriated it, i.e. the funds, they could be facing jail time. And does that not concern somebody? Now, my take, that's like running a bank on the honor system. Crowdstreet said it has since instituted an escrow policy for investor funds, but that's little comfort for Nightingale investors. A Wall Street Journal review of those deals' operating agreements found some pretty weird stuff in it. To wit, an arbitration clause stipulated that disputes would be settled by rabbinical court. 2 weeks after the fiduciary's revelations, Crowdstreet CEO Torstein was out. It's unclear to me how the firm survives a scandal of this magnitude. It's like you had one job: verify that the deal's closed before you release the funds. The fiduciary now is supposed to give investors another update on Friday, August 11th. And meanwhile, Schwartz is staying silent.